Welcome to the Stock Market Palantir. Today we are going to talk about NNOX. Welcome to the debate. So today we are focusing on Nano-X Imaging Ltd, ticker NNOX. This is a stock currently trading around the $3 mark as of November 2025, and it presents one of the most, compelling yet contentious cases in the entire healthcare tech sector.
It really is. It's complex because NNOX exists at this volatile intersection of novel medical imaging, the rapid implementation of AI, and frankly some highly speculative market mechanics driven by significant short interest.
Exactly. And the company has recently made some major strategic shifts, pivoting hard toward a software-centric model, Nano-X AI, and away from its challenging hardware roots. So that brings us to our central question today. Does this recent upward volatility and management's strategic reorientation represent a genuine validation of NOX's fundamental value and a high potential setup? I firmly believe that the recent catalysts, combined with extreme structural illiquidity, create a compelling upside that significantly outweighs the historical baggage.
Now, I take the opposing view. While the story sounds appealing, I'm going to argue that the recent price action is primarily driven by, unsustainable retail fervor and these opaque market structures. I maintain that the high structural selling pressure, its precarious financial health, and persistent behavioral risks, they just dominate the narrative, making this whole thing a high-risk liquidity event rather than a true fundamental turning point.
My position really centers on a critical inflection point, one that was signaled by this strategic move. The key catalyst is the partnership with 3DR Labs, announced on November 18, 2025. This deal is transformative because it fundamentally decouples future revenue from the Nano-X arc, the company's initially slow to deploy capital-intensive digital X-ray source. The difference in strategy here is just vital. Instead of hospitals needing to buy and install expensive hardware, Nano-X can instantly deploy its suite of high-margin Nano-X.AI algorithms through 3DR Labs' existing network of over 1,800 U.S. hospitals.
Okay, but you're valuing the potential of that pivot. I'm much more concerned about the reality of the structure.
Well, let me elaborate on that value. We're talking about high-value computer-aided diagnostic tools, Health CC Engine, which screens for coronary calcium, Health OST for early signs of osteoporosis, and Health FLD, which flags fatty liver disease. This shift instantly converts NNOX into a scalable, high-margin software-as-a-service, a SaaS model. And beyond this, the market structure itself is primed for an explosive move. The short interest is sitting at around 7.28 million shares. That's nearly 12% of the float. And crucially, the days-to-cover ratio, it's exceptionally high, between 8.7 and 9 days. This constraint, coupled with a high borrow rate approaching 10%, signals severe illiquidity for anyone short the stock. Any positive news translates directly into a vertical accelerated price move because shorts are, in a sense, structurally trapped. And one more thing. I have to clarify a misconception. The company has not done a reverse stock split. The price erosion was organic repricing, not financial engineering.
But I disagree that the structure supports a sustainable rally because the mechanics to me point toward intense, persistent structural suppression. If you actually analyze the data, the off-exchange short volume ratio throughout November consistently hovers above 50%. It often peaks past 60. We saw 63% on November 7th. Now, this high short volume is largely market maker hedging, often related to, wholesale internalization via payment for order flow, or PFOF. Market makers internalize retail buy orders and they short the stock off exchange as a hedge until they can find a natural seller. So they are constantly feeding supply into the market to offset retail interest, which acts as a heavy, continuous headwind.
But that's exactly what creates the volatility when a catalyst hits.
Perhaps, but the sentiment fueling those buys is often fragile and built on what I'd call hallucinated value. A key example is the rumor that NVIDIA is actively buying NNOX stock. This is demonstrably false. NVIDIA's stake is a passive legacy position inherited from the 2021 Zebra Medical acquisition. So retail flow chases this misinformation, providing liquidity for sophisticated investors to sell into, and most critically, the fundamentals are still precarious. The GAAP net loss last quarter was $13.6 million. With only $57.1 million in cash, the company is looking at maybe 4 to 5 quarters of runway. This financial reality mandates continuous use of their at-the-market or ATM dilution, where they sell new shares directly into the market. That's a constant supply increase and a perpetual drag on the share price.
Okay, let's address that financial reality because I believe the 3DR Labs deal is precisely the mechanism to escape that dilution spiral. I acknowledge the net loss. Growth companies, especially ones transitioning to a scalable SaaS model, they often run at a loss to capture market share. But the $3 million in quarterly revenue, showing a solid 32% year-over-year growth, that confirms the company is moving past the vaporware era. The market isn't repricing the stock on current GAAP net loss, but on the potential for future high-margin revenue from this deal.
That's an interesting projection, but we have to dissect that $3 million in revenue. The source material shows that the vast majority, 2.6 million of it, still comes from lower-margin teleradiology services. That's historical, services-based income, not the high-margin Nano-X AI software that's supposedly driving this pivot. The AI revenue acceleration is still a promise, not a measurable reality. And you just cannot ignore the ATM dilution. They have an agreement to sell up to $100 million of shares. They are actively selling shares into the market to manage that $13.6 million cash burn. That means the market is guaranteed a continuous supply increase that systematically nullifies short-term wins.
I'm not convinced that the dilution threat fully negates the fundamental change because the market reacted so strongly to the November 18th news precisely because it signaled a definitive change in the future revenue mix. And sophisticated capital seems to agree. Insiders like the CFO, Rand Daniel, are making small but symbolic open market buys, and institutions like BlackRock are actively adding shares, nearly 400,000 shares recently. If the ATM risk was as catastrophic as you suggest, why would informed money be building positions? That indicates a validation of the pivot.
Well, institutional buying can be misinterpreted. BlackRock's accumulation could just be minor index tracking adjustments. What really matters is that management has to dilute to manage that cash burn. The ATM allows them to opportunistically sell into strength, creating an immediate, predictable overhang that fundamentally limits sustained price appreciation even after a win like the 3DR Labs deal.
Okay, let's move to market mechanics then. You frame the high off-exchange short ratio as suggesting structural suppression?
Exactly. I cited the high ratio, often above 60%, to suggest that much of the shorting is structural. It's wholesalers hedging large retail buy flow routed through PFOF. It's risk management, not necessarily directional bearish betting. And that type of hedging can sustain incredibly high short volume without yielding to a classic massive short squeeze, unless the news is just seismic.
That's a compelling point on the non-directional nature of some shorting. But have you considered the cost? If this is all just passive, non-directional hedging, why is the cost to borrow, the borrow rate, so extraordinarily high, approaching 10%? A high borrow rate signifies intense demand and constrained lending supply. It forces shorts to pay a severe premium. That 10% cost suggests that a significant portion of the short position is directional, or at the very least that market makers face real risk and have to charge a premium to lend.
I agree. The borrow rate suggests real risk is factored in, but you have to look at the behavioral dynamics limiting the squeeze. Before this 3DR Labs news, the retail base was already highly polarized. It's fractured between fatigued bag holders, investors who bought in at $40, $60 years ago and just see this as an exit opportunity, and speculative optimism built on shaky ground, like that debunked NVIDIA rumor. This environment creates instability, where any upward move is met with supply from legacy holders, which just caps any sustainable squeeze.
While that psychological barrier is real, we have to recognize the technical setup that was primed for this news. Before the 3DR Labs announcement, the stock was in severely oversold territory. The RSI was below 30, so technical pessimism was extreme.
When you combine that with the structural constraint of a 9-day short cover requirement, the fundamental news had to cause the 13 to 20% price spike we saw. The structural illiquidity, regardless of the source of the shorts, acts as an accelerator. It maximizes the upward impact of genuine progress.
Even if we accept the technical priming, that movement tends to be volatile and short-lived because of hidden institutional risks. Let's talk about the risks retail investors often overlook completely. The company may be classified as a passive foreign investment company, or PFIC, for U.S. tax purposes. The company itself admits this is a possibility in their SEC filings.
Wait, for the benefit of the audience, can you briefly explain why the PFIC designation is so punitive for U.S. holders?
Absolutely. So a company is generally deemed a PFIC if, say, 75% or more of its gross income is passive income, or if half its assets produce passive income. Since NNOX is an Israeli company, if they qualify, U.S. shareholders face really punitive tax treatments. This is critical because it can include taxing deemed distributions at the highest ordinary income rate, and this is the big one, eliminating the favorable long-term capital gains tax treatment. It severely raises the cost and complexity of holding the stock, making it a material deterrent for institutional capital.
I acknowledge that PFIC risk is a real high-stakes consideration for U.S. institutions. But if this risk is the primary reason for caution, why are we seeing active strategic purchases by some large firms? You rightly pointed out that UBS and Goldman Sachs reduce our positions, but how much of that is truly PFIC avoidance versus just routine portfolio rebalancing? The accumulation of shares by other major players suggests that the future revenue stream and pivot outweigh this complex tax risk for some sophisticated funds.
The difference often lies in the fund's mandate. Active, tax-sensitive managers will reduce exposure because the potential for that PFIC designation creates a massive headwind. It just limits the institutional appetite you need to sustain a rally above this price range. That regulatory complexity, combined with the financial uncertainty, is precisely why we see these major players reducing their exposure even after the 3DR Labs deal.
The fact remains that the pivot to a validated higher-margin SaaS model gives the company a new, accelerated future, and the market structure guarantees that future execution will be rewarded disproportionately.
And the fact remains that the immediate financial reality, the constant threat of dilution, and pervasive structural selling create immense headwinds that make it a highly risky speculative asset where upward movement is constantly suppressed by new supply.
So, my central thesis remains that NNOX has fundamentally changed its identity. It's gone from a struggling hardware company to an AI software play, evidenced by the 3DR Labs partnership accessing over 1,800 hospitals. This new, high-margin revenue path, combined with the extreme illiquidity of the short position, that 9-day cover constraint, it primes the stock for disproportionate upward volatility on future positive execution. It's moving beyond the pure meme stock category.
And conversely, the divergence between the corporate story and the balance sheet remains significant. The underlying financial reality of a $13.6 million net loss per quarter, the continuous dilution risk from the ATM, and the pervasive influence of opaque off-exchange trading. It all means the stock's price action is more structural than fundamental. Investors have to recognize the persistent risk factors, including the high cost of holding long positions and regulatory risks like the potential PFIC designation.
So the future of NNOX will be determined by the interaction between management's ability to capitalize quickly on this 3DR Labs pivot, to convert that promise into undeniable high-margin AI revenue, and the structural challenges posed by the high short interest and the risk of dilution.
It's a very delicate balance between narrative potential and financial necessity. The outcome really demands continuous scrutiny of both the fundamentals and the intricate plumbing of the market microstructure.
Thank you very much for hearing us. Let us know in the comments, what is your opinion? And if you want us to analyze other stocks, don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.